We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, thanks for joining me today. How are you?
Very good, Tom. Thanks for having me. Looking forward to this conversation.
It's always a pleasure, Tavi, and you and I always have a great chat. And I want to start by kind of talking to you today about how many bearish signals we have coming from technical analysts as well as macro analysts right now. Do you see this as a time to be cautious?
No, I don't think this is a time to be cautious. It's a time to be busy, and we're seeing the validation of a long-term thesis playing right in front of us. There is an inclination that is natural of a lot of investors to see this big move in gold and think that this is a correction ahead of us, or saying things are overbought, that it's a very crowded position. And all those things are probably true, but there are moments in history where we see these moves in gold that we've seen in other times that have nothing to do with technical reasons, that have nothing to do with positioning, has everything to do with the magnitude of the debt imbalances we have. And, I think we need to understand what's been occurring from a standpoint of, who benefits from higher gold prices right now, and what are the goals of most of these large buyers of the metal, of which we don't even have enough data to back that up in terms of, I have my own, suspicion of who is probably buying, and large central banks. We've seen China, Russia, Turkey, all sorts of places that have been, and other South Asian economies, and even the emerging markets in general have been large buyers of gold itself. But what I think it's occurring is if you think about this whole topic about the revaluation of gold, for instance, and the fact that the U.S. government is in a situation, almost a major dilemma, of which it has to lower rates at all costs. There is this kind of obsession from markets about the 10-year, the 30-year yield, which are completely meaningless in the sense of where the debt is, right? I mean, that only represents 13 to 15% of the debt, right? So where is the big moment here of the debt situation is really on the notes and the T-bills. And so we need to lower the 2-year yield, the 5-year yield, the 7-year yield. That's where that's really coming from. Why am I saying this with gold? Because the revaluation of gold topic is absolutely critical to allow the Treasury to do a few things to help lower yields. Scott Besson was in an interview with a Bloomberg reporter in Argentina, and where he talked about this. He talked about, look, if the Fed doesn't play ball, if don't see much of a cooperation from Jay Powell, of which Trump has said that he might even fire him, and if that happens, accelerates all this process. But let's just assume that there's some stubbornness and some issues about firing him for the next couple months. And so how is that going to play out? Well, he said, we have our own toolkit. We have our own things that we can do. He's referring to specifically about Treasury buybacks. He's referring to instructing the banks to buy Treasuries and so all these other things. If you're going to do buybacks on the Treasury side to reduce and suppress, literally manipulate interest rates lower because you're buying back Treasuries, what you need to do is you need to revalue gold, because the buybacks can only happen if you use your TGA account, the Treasury cash account. So no, it's getting complex, but the higher gold prices go, the higher the revaluation and the collateral change of that availability of cash to use to buy back Treasuries would be there to be used. And so I do think that it wouldn't shock me at all if the U.S. is actually accumulating gold while everyone is being bearish here, and because of the positioning, because of the overbought signals, and so I'm very cautious about being bearish on just because something had a big move. And especially given the history of what things could play out here. So I do think that, maybe we I don't think this is the time to be looking at that way. In fact, I think things that have lagged relative to the metal are even more attractive right now they could ever been. We're talking about miners, we're talking about silver, gold to silver ratio at 100. You have platinum that also is extremely cheap. Every commodity in the world today is basically cheap relative to gold. So there's a lot of things that you could be doing to take advantage of this big move if gold prices, in my view, belong to the levels that we're seeing now. And I do think that that's the case. And I think it belongs even higher. So sorry for the long answer, but I just don't know too many. Actually, I don't know any technical analyst who's done very well in the markets over the long term. So relative to guys like Pierre Lassonde and Eric Sprott and Tom Kaplan and all these guys, I guarantee you these guys are not looking at the RSI of gold or anything along those lines.
Mm-hmm. Well, I appreciate the long answer, Tavi, because, all of these things do really fit together. But, going back to this idea of basically monetizing the asset side of the balance sheet, Scott Bessent has said as much that they're going to be monetizing the asset side of the balance sheet. And then after that, he said, well, I wasn't speaking specifically about gold. What else is there on the asset side of the balance sheet to monetize, if not gold?
Yeah, no, there's lots of things. There's, I guess, two separate things. One side of it is the sovereign wealth fund, which is the monetizing quote that he said was referring to that first and foremost. And you've got TikTok and all U.S. steel producers. They just blocked U.S. steel from being purchased by a Japanese firm, and because they don't want a foreign owner of this, such a protected industry that we need to. It's we're relying on these things. So there's all these potential monetizations that could happen by some of these companies becoming state-owned companies. Who knows? Of which I'm not saying it's a good thing or a bad thing. I'm just saying that's what they're looking into. There's also a lot of resources in the U.S. that I believe Ludnick has talked about extensively about how we can unlock a lot of value from resources we have in the U.S. In terms of trillions and trillions of dollars of again commodities that have been unexplored and underdeveloped and so forth that could be developed and unleash a lot of money. I think that's really where the sovereign wealth fund's coming from. Now, the revaluation of gold has been, in my view, has not a lot to do or anything to do with the sovereign wealth fund. It has a lot to do with the fact that what enables the government to actually buy back its treasuries and maybe build a position on crypto and all these other things that are all masking the big, in my view, are masking the big story, which is that gold is under a lot of demand from large central banks in a world where debt is an issue. There's de-globalization and all these countries looking to onshoring, and everyone wants to stabilize somewhat their monetary systems through the accumulation of gold. And so I think that's really where the revaluation of gold comes from. If we revalue gold at current prices, would probably add 800, maybe $900 billion to the Treasury cash balance, just because the increase of collateral value would increase the TGA account. And right now they have about 300 billion there. So if you add another 800 or so, you can do the math. We're above $1 trillion. That's your non-QE. They don't want to call it QE, but it is basically QE. Capital available to be used, and this is conducted by the Fed, but actually would be it would only be purchased by the Fed, but would actually be happening through the Treasury. So the Treasury is the one that actually does the direction of those policies versus the Fed itself. So the Fed has no saying outside of helping to perform those tasks. And that's probably what's likely to happen. If you look at the 1940s playbook, we did see a lot of policies that are very similar to the attempt today. This change of the supplementary the SLRs on the banks and allowing the banks to, or really not allowing, it's influencing the banks to become buyers of treasuries again. This is all stuff that we saw in the 1940s. We need to find pillars of buyers of treasuries. Mar-a-Lago Accord, maybe Argentina decides to be buying treasuries in exchange for a swap line of dollars to help their currencies, the currency situation and so forth. Certainly see that. I can see other South American economies doing something similar as well, and being buyers of U.S. treasuries as a result of those agreements. And so I'm not saying that's what it fixed, but those are pillars of buyers of treasuries that need to be in place. And so clearly, the administration has a goal, which is to fix the deficits. Two things: the trade balance and the fiscal. And the trade balance needed to be fixed by weakening the dollar, and the fiscal side needs to be fixed by lowering rates. And they're combined. Those two things are basically what's going to create the green light to invest in emerging markets and all sorts of things, in my opinion. So that these are all kind of linked in with this gold revaluation idea as well.
Mm-hmm. Well, you guys recently put out a chart based on this idea of gold revaluation versus the amount of debt, and I'll share it on the screen here. Tavi, if you could walk us through what this chart actually says about, let's say, the historical mean value versus current valuation of mark-to-market gold versus the debt, and as you said, where we were in the 40s as well.
Yeah, and so first of all, this chart is actually already marked to market. In other words, it's already using the current gold price, and it's just putting into perspective because it's ridiculous marking at $40 an ounce. So I guess this is just showing you, even if we mark to market, we only own about 2% of the total amount of debt outstanding. Why am I using debt outstanding? Is because there has been a lot of research where they use monetary base. Monetary base is less than $3 trillion. That's not representative of our economy. That's not representative of money supply. Money supply is a little bit above $22 trillion in the U.S. That's also not representative of the total amount of money that has been created, especially if the government alone has about $36 trillion of debt outstanding. So I think it's important to look at the gold reserves we have relative to the treasuries outstanding. And it's just a way of seeing how much of our debt in the U.S. is being backed by gold reserves. And a lot of people will say, no, it's backed by the military and all that. I don't even want to get to that discussion because in the situation we are today, where the U.S. is losing relevance internationally, I think that it goes back to the ownership of gold in a large way. And yes, I don't think that that's the only thing that we should be anchoring the value of treasuries, but we also shouldn't be ignoring the fact that we only own 2% of gold reserves relative to U.S. treasuries outstanding. And then we look back in history, which is extremely relevant to always do. Back in the 70s, we saw somewhere close to 17% of the treasury outstanding was backed by gold. And back in the 40s, before the World War II, was actually close to 40%. Why did we see a drop during that time? It was two things. Well, first, we did see after World War II, the U.S. actually sold a bunch of their gold reserves, which was insane policy that happened. But also you did see the fact that the money supply or the government debt increased substantially, as shown in the white line of that chart. And so that was actually what caused the reduction. So the relevance of that research also shows you where prices could be if we do see anything close to those reserves being backed by gold one day. And you start seeing numbers like $20,000, $50,000 an ounce. And this is why, we are at that moment in history where, if the U.S. does think it owns more gold than other countries, and I don't think it does as of now, perhaps it does, but it's a tough call to be making, especially given the fact that we also are at 90-year lows in terms of ownership of gold relative to the rest of the world, which is in a 60-year highs or 50-year highs. So this is all officially, reported reserves. We don't know what's unofficially held by these countries, China and others. And so my point is, I do think that the U.S. has been opting out of the buying spree of gold, and it's probably going to be coming back either quietly or more openly, and I think that's inevitable.
Mm-hmm. Well, Tavi, when as we think about this and this revaluation of gold, how does the current tariff war also affect the Fed's ability to finance itself and to finance the spending that the country needs at these current yield levels? And what does that also have to do with the current price of gold?
Well, I do think the tariffs will stay, but also are a huge part of it is certainly a strategy of trying to fix this chronic debt, or I should say chronic deficit on the trade balance aspect in a big way, and trying to perhaps create some level of agreement with these countries, the so-called Mar-a-Lago Accord and so forth, which would be another way of restructuring the debt by pressuring these countries through the tariffs. And by no means I'm saying the tariffs are going to go away, but I also think that the levels that have been presented are also going to be potentially substantially lower than what's being shown. And the market might even see this as positive news and more clarity on this uncertainty that people are seeing in equity markets in the U.S. I don't share the same negative sentiment because I think this is we're about to see some big, potentially some big agreements in the near future. In terms of the Fed's ability, and the government ability of its debt and so forth. Look, I think that there's going to be some real pressure on the short end of the curve of the Treasury market, and so Druckenmiller has made a lot of money shorting 2-year yields in the past, or being long 2-year Treasuries, betting that 2-year yields will fall. I think that's probably one of the most compelling macro trades out there is to think that the 2-year yield could be cutting in half in 12 months from now. And I firmly believe that would be the case, even from a manipulative standpoint or just organic. And so I've been of that opinion. I also think that we've seen some of the sort of reflection of these policies, the tariffs and others, on the dollar. We've had the dollar being extremely weak relative to other currencies. I just want to point this out because not that I didn't get credit for it, but that I actually think that I really think this is a long-term trend. Back in July, actually September, and also back in December, I doubled down on this view that the dollar was at its peak. I did not know the dollar was going to peak that day or the next day. Had no idea about that. Mm-hmm. And the same thing goes for commodities. When we came in and started buying commodities and got into mining, we had no idea commodities would turn, that COVID was going to happen. But you can kind of see the foundation of a thesis happening here. And I've been a believer of the milkshake theory, for instance, the dollar milkshake theory. We wrote about extensively, our friends with Brent as well, wrote extensively about the China Lehman Brothers moment back in 2015, 2016. If you remember, we had a lot of interviews about that. I've changed my view on this. And the main reason why I changed my view is because the interest payment to GDP in the U.S. versus these other economies is substantially higher. And I think that the U.S. is going to be forced to lower rates a lot more than other economies. And as we see that, that's going to have a reflection on the dollar. Now, we've seen a lot of this being impacted on the dollar already. And so I don't want to double down on that idea, in the near term. I think there's going to be another window of opportunity for that to be the case. What I want to be doubling down on is that the 2-year yield needs to collapse. And I really mean it. I don't think it's almost like it's insane that we're still hovering around 4% on the 2-year yield when probability of recession has increased, when you have an administration that is solely focused on lowering the cost of the debt, which they could have full control over if they fire Jay Powell and fix the issue. You have a stubborn Fed that is not lowering rates. Therefore, the short end, the 3-month and the T-bills themselves are actually too high and are could be the cause of a recession that would cause the 2-year yields to collapse as well. So I am a very big firmly believer that the 2-year yield is extremely overvalued from a yield perspective, and I think that we could see that be cut in half in the next 12 months. And that's going to be very meaningful for markets. We can talk about some of the ramifications of that from a macro standpoint as well.
Well, that's exactly what I was going to ask you, Tavi. If we've really entered this structural downtrend, as you guys call it, structural downtrend for the dollar, what does structural downtrend mean, and what are the ramifications of the the dollar losing power, losing value through the world?
Yeah, and the discussion that usually gets to is the extreme things that when you start talking about the dollar of will the dollar lose its reserve currency status and all sorts of things, and that's completely, in my view, meaningless relative to the opportunity and the trend that we're likely to see. Mm-hmm. There have been multiple downward trends on the dollar that did not cause it to lose its reserve currency status. The dollar is simply too overvalued. That's it. It's way too overvalued. It has been going up for too long. The dollar milkshake theory has played out beautifully. It has attracted too much capital into the U.S. U.S. equities or U.S.-based equities, U.S. dollar-based equities and bonds and corporate bonds and treasuries have done extremely well over the last few years because of that influx of capital from outside. You look at the MSCI World, where 70% weight on the U.S. You look at most central banks even have holdings of U.S. equities in their balance sheet, including technology companies and so forth. And so that is completely unsustainable. We've seen too much of that. We need to see a rebalancing out of this of a world where U.S.-based assets benefit tremendously. And so again, this is not the end of something, but it's usually dollar trends tend to be very long-term oriented. And I think this is the beginning of a structural bearish moment for the US dollar, of which we may see not only efforts from the administration, but also, again, goes back to the interest rate differential. The US is in a bigger position to lower rates than the Europe. People will say, but Europe, are you saying Europe is the new? No, I'm not saying that at all. All I'm saying is that when you look at how much it's costing European countries to pay their debt versus the US, we're talking double. We're talking maybe even higher than that, depending on the country. Some countries is triple, quadruple. Japan is quadruple, right? I mean, Japan is paying less than 1% of its GDP. So, and think about the Japan case. What caused their currency during that process of lowering their interest payment relative to GDP? Collapsed their currency. Their currency is in the toilet because of that. What happens if the US has to do that? That's the lenses I think people need to be looking into this right now. And this is almost like, it needs to happen. We're almost as overvalued, or in some cases, depending on how you look at, if you look at the Fed traded weighted index of the dollar, we're now as overvalued as we were back in the Plaza Accord. That was a coordinated act. We saw countries coming along and saying, well, let's reduce the value of the dollar. What if this is part of the Mar-a-Lago Accord? Have we seen the tweet from Trump saying that non-tariff issues of people manipulating the currency? What does that mean? That means that he does not want these currencies to be too strong versus the dollar. So, okay, now let's go back to not just this whole big plan and this whole big structural, sort of change in the macro landscape, which would be a big structural change. But let's think about, what does that do to markets? Does that mean it's the end of the US? No. But at the same time, right now we're seeing a big decline in equity markets. Equity markets in the US and globally have fell apart because of the tariffs and all these things. And I would argue that, we're close to some sort of agreement, as we see that occurring, that the rest of the world is going to likely benefit tremendously in the next 12 months. And so I'm extremely bullish the rest of the world. I'm extremely bullish emerging markets because they have also underperformed the rest of the world. So there's so many rebalances that could happen, not only out of the US into the rest of the world, but also within the rest of the world. It needs to come back into emerging markets in a large way. Mm-hmm. And I don't mean this specifically talking about China. I mean this in South America specifically. I think that's a very underweighted part of the world right now. and that's likely to be a big winner for the next 2 to 3 years. And so think about one thing, last thing of just final thought about this that is extremely important. What are the two factors that usually hurt emerging markets? Strong dollar and rising interest rates. Look, both things are going to be capped here. I don't know how they're going to do it, if it's going to be forcing the banks to buy treasuries, if it's going to be firing Powell and lowering rates, if it's going to be doing a Mar-a-Lago Accord and restructuring the debt at a much lower rate. I don't know. But one of these policies are going to come through, and maybe all of them, and they're going to lower rates. And when they do that, that's going to be positive for emerging markets. If you look at government bonds in Brazil now, they're paying almost 20% yields right now. So there is a positive carry in most of these assets that people are completely ignoring because of the risk, historical risk. When you look ahead, those risks are likely to be removed. We're likely to be a cap dollar and a cap yield environment and getting paid for it. So I do think emerging markets are in the very important turning point right now.
Tavi, I'd like to turn to talking about gold and gold miners. This is the first time since 2001 that mining stocks have appeared this attractive as compared to U.S. equities from a free cash flow yield. So that period marked the beginning of the industry's one of the strongest decades for that industry. So is the mining industry still under-owned, or is it appropriate considering that this rotation at this time?
Oh, I think it's extremely under-owned. I love ideas that you have. They usually have this sort of legacy behind it. So these are industries that take have been in part of our economy globally for a very long time. They're critically important for to function the world, and we're talking about onshoring. And we're talking about the issues with even affordability of housing. There's clearly a need for a lot of construction to happen in the world, a world that is trying to avoid dependency with China and other economies. And industrial capabilities need to be built up. We have electricity consumption about to double, triple, depending on the situation with artificial intelligence, and we're not ready for that. So mining is going to be a critical part of the economy. Back in the 1960s or so, it used to be close to 20% of GDP, mining alone. And now it's 0.4% of GDP. So that's going to change, in my view. And I'm talking about the U.S., by the way. And that's going to change globally, but that stat came from the U.S. And we're so reliant on imports of metals, import of even the situation when you talk about smelters and refineries that come from China, and the fact that we're so reliant on those things. These conversations are just getting started, and I believe we're going to see some big changes along those lines. It's not just going to be the steel producers; it's going to be all the mining companies. When Lutnick was talking about unlocking all this value from natural resources in the U.S., that's what he's talking about. He's talking about as well mining. Receiving investments from large capital allocators to build most of these projects and see things come to fruition. So you can there's two types of investors when they see these issues with the fact that we're seeing gold prices surge to levels we haven't seen any other time in history. At the same time, the miners continue to be so cheap. So those two investors one of them are the ones that look at it and say, there's a chronic problem, there's an issue, I don't want to touch this. And the others that will see this, the lag is your friend, and there's clearly an opportunity. I can tell you from an insider of owning a private mining vehicle as well, that I've never seen margins being so attractive as they have been today. And I don't think this is unique to what we own. I think this is unique to the whole industry. So I think that this is, if the public markets are not seeing it, the private markets are. The private markets are extremely competitive now to purchase mines. And I think it's only going to go up from there in terms of attractiveness. And remember, the gold miners have outperformed U.S. equities, dividends included, in the last 10 years. Did you know that? That's insane. Not a lot of people know this. Everyone likes to buy the U.S. equity markets, but miners have actually outperformed them. What they have not outperformed is gold. And that just means how cheap they still are. That just puts you into perspective, like they have outperformed the US markets and they're still really undervalued historically speaking. So I do think that this is just the beginning. And I'm extremely excited about this. I've said this before. I think this is the golden age of mining. And even if gold prices, well, let's just assume all the technical guys are right and we see a correction. Let's just say we'd see a correction back to 2,500, which would be insane. $2,500, these miners, majority of them are currently with all sustaining costs of 1,500 or even lower, depending on the case. The gold to oil ratio is at the second highest level in history. So margins have really expanded. It won't damage their bottom line. In fact, they will still be making money in that situation. So I really don't think that people are overlooking the situation. And I would not dismiss this opportunity at all. I do think that's going to be also rebalancing out of tech and all these things back to mining. We're seeing some large technology investors already coming into the space. I think that's just the beginning. I think we're going to see a lot more of that. And so for those who have been in this niche environment, and they're shying away from it, I don't know. I don't know what to say. I mean, this is your moment to shine right now. So I love it. I think this is extremely bullish, and I'm super excited about the next few years.
Mm-hmm. Tavi, you mentioned this possible correction. Like if we do go back to 2,500, I would think that that's going to be obviously associated as well with a major correction in the equity markets or a further correction in the equity markets. What do you see happening to the mining stocks in a situation like that? And does history tell us anything about an example like that?
So a few things on this. First of all, I am not bearish on gold. First of all, I don't think we're going to see a correction here. I'm not too concerned about that at all as other people are. I think we just saw a correction not too long ago, where gold went from 3,100 or so all the way back to close to the 300 or so, a little lower, and then we saw a V-shaped recovery that has been, and now it looks like a check mark because it's gone up so much relative to that dip. But that's kind of the dip that was more concerning, and now we put that away from us. Now, to answer your question, there has been a lot of focus in 2008 as a type of recession and behavior of markets. Markets can fall, equity markets, and you may see miners do okay. There are many examples of that in history. You can look at, for instance, the early 2000s, the very beginning of the early 2000s, the miners got caught up on that sell-off and then immediately diverged from the equity markets, of which NASDAQ and some other technology companies went down close to 90+%. And equity markets in mining companies actually went up substantially from that. So talk about divergence, talk about alpha. It's insane how you could, potentially be on the right side of the market, despite the fact that we're seeing everything crumble. And I think that could be the case here, just given the fact that the fundamentals look so attractive. And look, I think that if gold prices do fall, which is not my view, it would hurt the miners. But I would suspect that the miners to gold ratio could even rise in that environment because miners would still be making money, in a big way. And I don't think people would really buy into that correction as a time to be, getting out of this whole industry and something along those lines. I think there'll be some selling pressure, but I'm not too concerned. I'll give another example of something that has been happening from a macro standpoint that is extremely important that did not play out in a way. I mean, have you noticed the fact that NASDAQ has been coming down recently and copper has been going up? And how would anybody explain that? Outside of going back to other periods and saying, whoa, hold on a second. In inflationary regimes, you can see metals rise as markets fall. And that's just because countries are securing metals, or they don't care about, that price that is on the screen right now. They just want to secure things from a geopolitical standpoint. And we know the case for copper in a world where there's so much push towards an AI arms race. How do you do that without also having a place where copper really benefits tremendously, and so it's right at the core of all these developments. And so I think that's really the relationship change between a supposedly cyclical commodity versus a equity market. So I think I view it the same way, really. So not too concerned at all. I think that the miners are changing their behavior. Hence why you're seeing markets, miners up over 30 plus per 40% or so, versus the NASDAQ and S&P 500 down substantially for the year.
Mm-hmm. Well, Tavi, many of the topics that we've covered already is this idea of this revaluation or this long-term imbalance that needs to be resolved. And it seems like gold and silver themselves are in that same situation. The gold to silver ratio recently hit 110. There's only a few other examples in history where it got that high. So what do you think explains that undervaluation of silver compared to gold as well?
I think there's, potentially a lot of reasons. I think there has been lagging, not just specifically to the metals and mining industry, but in a lot of other things. Now, I'll give an example. When gold prices rise and you get into a downward trend of the dollar and capped yields environment and so forth, you tend to see emerging markets do very well. Well, emerging markets have been lagging, just like the miners and maybe just like silver. At the same time, it hasn't been a terrible situation for these vehicles. I mean, silver alone is trading above $30 an ounce with a gold to silver ratio over 100. So it's extremely, in other words, it's extremely undervalued at its very high prices relative to history, at least in the last few years, the last few decades. And I think that's a wonderful outcome, a wonderful setup to be in. We could see silver prices, please don't quote me on this, but we could see silver prices at, double, triple levels that we're seeing now, and it would still be very plausible because of the gold to silver ratio. And I think that's wonderful. That's really great. And so I'm really bullish in silver right now. I think the catch up trade to gold is the most attractive thing to be doing. Is to be looking at how to expand your exposure to silver, for instance. Right now is to me, something that is on the top of my mind. If you looked at historically, the gold to silver ratio doesn't stay at that level. I think that's the most important aspect of that research of going back in history of the gold to silver ratio. And again, I've seen, not going to mention names, but I'm seeing technical guys say, "Well, this time is going to be different. We're going to see the gold to silver ratio go from 110 to 115, and instead of going back to 80 first." And can we think about asymmetry? Like, what's the asymmetry of saying that something will go from 105, 110 to 115 versus going back to 70 or 60 or 50? What this reminds me? When we were about to buy San Cristobal mine in Bolivia, silver was trading at $16 an ounce. I remember this very well. And technical guys came up to me and said, "Well, Tavi, be very careful because, we think silver is going to go down first before it goes up." It could. And it actually went down to 15. But it doesn't matter. And their mindset, they wouldn't have done what we did because of this technicality of saying we could see $2-3 lower before seeing 30. Here we are at $30 an ounce now, and the gold to silver ratio is extremely attractive. And a lot of these guys would love to own a silver mine, but they don't because they were too cute trying to, time the market perfectly. So nobody knows how to time the market perfectly like that. You don't have to. I think that's overdoing. I think you're going to lose a lot of big opportunities by doing that. I don't think Warren Buffett built his wealth by trying to figure those things out. And it kind of annoys me because I do think that it unfortunately messes with the crowd. It messes with majority of the retail investors that can end up getting caught up into those narratives that are just completely meaningless. Mm-hmm. And, in my view, that's not how you build wealth. That's not my view. I mean, just look at the people that have done anything important with money in the past. tell you that it's not about breakouts and breakdowns. It's about owning something cheap and building value. And to me, that's what comes down to. So sorry to be harsh in that part of the industry of money management, but kind of pisses me off a little bit.
Well, I mean, Tavi, I completely understand it from exactly the statement that you just said, owning something cheap and building value. That over time, that we've seen the be the greatest way to build wealth in that way. And you mentioned earlier that you have a, let's call it a gold and silver / commodity mining vehicle that you guys have built at Crescat. Do you think that that's the best way to build a portfolio of these companies that are poised to outperform or to be able to appreciate in this coming environment?
But by the way, the vehicle I mentioned was St. Cristobal, but we do own, obviously, we manage a fund that has investments across many mining companies. I think there's a lot of ways to skin the cat in this industry. Majority of people like to do it in the development phase and the producing phase because it's just easier to understand these companies. The lower you go in the market value and also the earlier stage you go, the more technical the industry gets and extremely complex. I just happen to have a great relationship with one of our partners, Quinton Henney, who understand the exploration side better than anybody else. And so, having the opportunity to have sort of the some of the best analytical ideas when it comes to where to invest in this space, and knowing that majority of this industry, most of the billionaires in this industry, I think all of them, have made their money in exploration and then switch to production and development at later stages as it makes sense. It becomes less risky. You already made most of your money, and but the big chunk of their money was made in that side of the market. So I think this is pretty. I think this is very interesting, and there's room for somebody to build something like a hybrid venture capital approach in the mining space. There's companies that put out great results and have just not been rewarded for that. And as long as you're not in those markets where companies have been dormant, they're not drilling, they're not trying to create value. I think there is lots of things you could be doing in this part of the market as well. And it's extremely inefficient, which I like it a lot. So Crescat have had a focus and a brand on that side of the market, of which has been, I would say, ignored over the years. Now, again, doesn't mean it's the only way to do it. Doesn't mean it's the best way to do it. It's one way that sometimes is a niche strategy is in my view always good when you find, of course, when you can again create value through a niche strategy is always a better way to do it. And there's just a lack of money managers in the industry. I mean, we know personally all of them, and which is, or I should say, I think most of them. It would be great to see more vehicles being created to bring more capital and attract more money into this industry. So I think that's also inevitable.
Mm-hmm. Well, I think obviously part of it is education. Part of it is being able to bring companies in and create that buzz and excitement by having vehicles like this that do bring more interest, do bring more capital into the industry, right?
Mm-hmm. Yeah, just looking at the when you get into, I think I talked to you about this before, but when you get into the buying of mines privately or other things, you start learning about how these industries form, and especially how the analysts tend to see the industry. And again, the analysts play a very important role, especially investment banks, because they are the ones that are the kind of the front door of the bigger allocators that don't understand the industry and are first looking for those guys to be presenting to them some ideas and how they view the market. And I think that they underestimate a lot of times because of how the industry has been built, and because of how the industry has been forced to use ultra conservative metrics to look at future cash flows and so forth. And it hurts this industry because it's, essentially we are sandbagging in a big way, in my view, a lot of the fundamental change that is likely to come in this industry. And hence why a lot of times the miners tend to lag until they actually show real numbers or reported numbers that they're improving fundamentally. And maybe that's going to be the case here. We're going to have to see the actual reported improvement before people really get into starting to get more bullish about this whole industry. And I think that might be the case, might be what we need. It's a few positive earnings reports, but yeah, this industry needs a lot of education. It's a very complex industry. And for those who think that a complex industry can never become, quote unquote, sexy again, I disagree. I disagree because there's nothing better for marketing than making money. When people start making money, everything looks sexy. And, hence the crypto industry. A lot of people say they understand crypto. I still don't understand a lot of things in the crypto market. And I still think that a lot of people that say they understand it, they don't. But because people have made money in that, they think it's really interesting. And so just wait and see, because I do think that the mining industry will become something that will become popular once again. I think a lot of people are learning. Right now, we're having a history lesson about gold. Now, how many people said gold is a pet rock and it's not used for anything? I mean, how wrong has that been? I mean, how many people in the technology front learn a lesson about gold? And the same is going to happen with the mining industry and silver and others. And I'm not I'm not shocked by it. I think that's just normal. And ultimately, this is going to be a big change in capital allocation, but also sentiment as well in this whole industry.
Mm-hmm. Tavi, I know we're coming up against time here. Is there anything that you'd like to leave our listeners to think about that we haven't already touched on yet?
I think we talked about most things. I would say that I think that maybe what I would be something we didn't touch a lot on is this rebalancing that may occur in the U.S. out of the mega cap names into other industries. I would not underestimate that type of trend, because I do think within the markets, in the U.S. markets, there are some industries that have been very that have not benefited from the changes we've seen recently. I'm going to point out one that I think today looks very timely to be looking at, which is the energy space. The energy space to me has been suffering tremendously from commentaries from Trump and the situation of drill baby drill and so forth. And look, I am of the view that there's nothing more strategically, geopolitically than oil and gold. And gold has been reflecting a lot of those issues of de-globalization, but oil is not. And wouldn't shock me at all if we go back to triple digit numbers in oil in the next year or two. And I think if you are of that view, a lot of equities are extremely undervalued under that assumption. And so I wouldn't underestimate that as a potential change in the markets here. So I think it's time to be more overweight the energy market, to be specific, versus other things. So yeah.
Excellent. Of course, your investor letter, where I pulled some of those charts from, all of that stuff is available at Crescat, Crescat.net. And of course, you're an absolutely excellent Twitter follow at Tavi Costa. Tavi, thanks so much for your time today. Always appreciate chatting with you.
Thank you, Tom. I always appreciate the interviews and the invitation to be here. So thanks again for doing this.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.